even though investors have experienced decent capital gains from bonds, is this the reason to own this asset class? Are investors making fear-based decisions when investing in bonds? Welcome to the show, gentlemen. Thanks so much. This is an interesting discussion, of course, Roland, because looking at bond inflows just into South Africa this year, we've had tremendous bond inflows, and it's really interesting to see that investors continue to flock to an asset class that, I suppose at the beginning of the year, many were saying they're going to shift out of bonds because they don't believe that the rally can continue, and it has.
Well, since the beginning of this year, we certainly have, from a risk-adjusted basis, seen property and bonds really do extremely well. The reason is clearly international investors trying to chase some yield. Generally what happens is you want foreign investors to have a stable currency, and although the currency hasn't been that stable at the beginning of this year, it's starting to stabilize now, so we could even see maybe even further inflows.
So Albert, let me bring you into the conversation. What is the relationship, and is there any relationship between dividend yields when you're talking about equities and bond yields?
Well, that's a difficult question. I think one of the interesting things that we've seen in the last couple of years is that dividend yields have risen while interest rates have fallen globally. It's interesting that this has happened almost in the 50th anniversary of when it split and turned around the first time. In the end of the 1959, beginnings of 1960s, interest rates for the first time globally started to be higher than equity dividend yields. This was an argument based on the underlying certainty of equity generating growth assets forward and continued certainty about global growth. The question is, has this returned, and has it turned around, and where are we in this going forward?
Yeah, just looking, we've got a graph on this, and of course you can see clearly there where the disconnect has been and the fact that returns have outpaced. But looking at that graph, things, I mean, how long can this continue for?
Well, I mean, you know, that's interesting. What you're looking at the moment is Robert Schiller's data from Yale University, and he's showing the long-term interest rate, and that's in the yellow line, or the orange line, so I'd rather say, relative to the S&P 500. That's American stocks, now the 500 largest in the US, and it shows their dividend yields. Now, the graph goes back quite a long way, back to 1880. But, you know, kind of looking at anything kind of before 1970, you can see that dividend yields was way higher than what you could get actually in your long-term interest rate. These are 10-year averages. And then you saw that switch that Albert spoke about just now, where you saw rates actually climbing on its 10-year averages, and you saw dividend yields actually dropping as the environment changed, and actual dividend yields became far more tuned to growth companies, and people started saying, well, look, there's going to be growth out of these. But if you just look at that chart quickly, just once more, because what you'll see is how dividend yields actually are starting to tending upwards, whereas your long-term interest rates are starting to come down. Maybe we're sitting back at a point where there could be a structural shift back to what we saw before 1970.
I mean, it's interesting you say that, because the underlying assumption, the underlying argument that was made to pension funds at that time was that dividend yields can be lower because companies will be paying an increasing dividend yield every year for the next 5, 6, 7, 10, 20 years.
So it's the compound factor, of course.
The compound factor of compounded returns going forward. If that is reversing, if the trend is reversing, it could be an indication that investors are saying that a lot of companies, they aren't expecting increased dividend yields going forward. They aren't expecting a company to pay 5 Rand this year and 6 Rand the following and 7 Rand the year thereafter, but 5 Rand continuing going forward. And that, combined with the fact that equities are inherently volatile, means that they would like a higher dividend yield on those companies than they can get from the relatively certain income from asset classes like fixed incomes and bonds.
But Albert, surely you have to adjust this for inflation, because the dividend yield is sort of more neutral towards inflation, because the dividends and the share price are equally affected by inflation. So inflation doesn't affect the dividend yield, but inflation certainly has a much bigger impact on the bond yield side.
Yes, I mean, I think you're entirely correct by saying that, but in this circumstance we are in now, a lot of people are saying that Japan is a template that where we are going to. So in the Eurozone, in America, Japan, we are in very, very low inflation environments. So even if the dividend yield does adjust upward with inflation, that inflation is going to be 1% or 0% or maybe deflation, like we've seen in Japan over the last decade, or even more than the last decade. So if we are in this balance sheet recession circumstances that we have seen in Japan and that we might see and continue to see in the US and in Europe, we could see low inflation going forward, and then the dividend yield won't automatically pick up with inflation like that argument goes about.
Yeah, and I mean, let's just face it, Samantha. I mean, within that environment, you know, when you're sitting with this very, very low inflation numbers, you're sitting basically with 3% dividend yields that look very, very attractive. Anything's attractive against, you know, kind of interest rates that are just so low. If you just look at your screen, you'll see how and where long-term kind of 10-year bond yields have gone. And what you're seeing over there is you're seeing it's kind of three big countries. Albert spoke about Japan, and that we might be a model globally for Japan. There you can see how their bond yields on the 10-year bond, how low that is at the moment. And you're seeing these from 1979. The other two countries is America in red, and then in blue is the UK. And you can just kind of see just the trend downwards as far as these bond yields are concerned. It just blows my mind that people are prepared to buy bonds kind of with 1.5–2% yields.
Yeah, I think it's a case of
and negative yields in some cases.
And negative yields in some cases. I mean, both in Switzerland and in Denmark, you have
and
the
France, Germany.
You have the front end of the yield curve actively trading at negative yields, which means that not just are you not getting any return on your capital, you are actively paying people just to keep your money safe for you.
So let's jump ahead to why that happens. Why we've seen negative bond yields? Because someone's saying that you've got large companies, for example, a General Electric.
Yes.
They're not going to sit with $1 billion just in cash in the bank. They have to put that money somewhere. Is that a reason? Or the LTRO also, safe collateral was considered to be, Northern European bonds, so they also had to use that. That was one of the reasons why you've also had bond yields go negative, because of the supply-demand factors. I don't know, what is the reason?
There are two primary arguments here. I think one is investor-based, where investors are so concerned about the return of their capital. They want to get their money back. And regardless of how safe a company is, the moment it goes bankrupt, the equity guys lose the money first, followed by a couple of the debtors, and so you have a significantly higher probability of getting your money back if you're a debt investor. If you move to some of your safer countries that have their own reserve bank and that can print their own currency that can pay you back, they should at least give you back your money at some stage. So that's the one side. Investors are focusing on the return of their capital rather than actually just getting returns. The other side is that governments are actively manipulating their bond yields for various reasons. We have to take into account that companies fund from various points on the bond yield. So if the government bond yields are low, that means that companies fund themselves at lower levels. And the argument is that if they can get funding cheaper, they can spend money for growth cheaper. That's the one side. The other side is in countries like the US, for example, households and homeowners literally fund themselves and get their home loans from the 10 or the 15-year point in the bond yield. It's not like South Africa where we fund our bond yields relative to the prime rate, the front end of the curve. They fund their home loans from the 10-year point. So if the 10-year point is low, it means that the people that buy homes can buy homes at a lower interest rate, and it helps to at least the theory is, it should help to stimulate the economy.
Yeah, and that's what we see the US doing there, trying to keep those interest rates low, trying to get that household sector continuing to take mortgages out, get the property sector back up and running. Your thoughts, Quibby?
I mean, I think the other big issue here for me is that if you look, this is predominantly a governmental issue. This is not a corporate issue. So we're sitting with a crisis which is governmental made, and this is in Europe and it's in the US. Now, if you take both of those into consideration, they don't understand how to operate in the equity markets. The equity markets is a risk-taking thing that lies on the side, and you kind of you let your public interact with that, but you don't interact with it as far as the government is concerned. So quite frankly, what you're sitting with in Europe at the moment is you see a lot of member state countries which are buying ECB bonds and then sitting with them on their balance sheets, so that they literally just have funding happening. And on the back end of that, they try and do some of their own bonds, and they're literally just trying to get the debt wheel to turn and turn and turn and turn, so they can try and kickstart GDP growth. And I mean, and that just provides kind of this major opportunity in equities at the moment. To show you what that opportunity looks like, have a look at that over there. That shows you the bond yields that I showed you just now. Again, Japan is in the orange line. The US, and these are 10-year bonds, is in the red line, and then the blue line is the UK bond yields. And then what I'm showing you over here is I'm showing you the S&P 500 dividend yield. And look where that has gone now. You're seeing the S&P 500 dividend yield, as a matter of fact, very similar to what the US 10-year government bond yield is giving you and the UK 10-year government bond yield is giving you. Japan obviously is way below that. And as a matter of fact, I mean, I just did a quick screen the other day on equities, on global equities. It's the banks, it's the resource companies, and it's predominantly the oil companies that are trading on these massive dividend yields, 4%, 5%, 6% in some cases dividend yields. And those are juicy, surely.
Roland, let's bring you into this. Just $1 trillion have flowed into the bond market since the start of 2009. We've seen, especially US Treasuries benefit from it. We've seen the likes of Germany, France considered safe haven assets. How much longer do you think this is going to continue for? Because, as I said, at the beginning of the year, we were saying we're going to start seeing a turnaround in this, but that hasn't been the case. So how much longer are bonds like those safe haven bonds continuing to gain?
Well, the one way to look at it is valuations, and obviously bonds are more expensive now than they've been previously, and equities, relatively speaking, are cheap, especially resource kind of counters. But it's not about valuations necessarily only. One also has to look, valuations are longer term determinants of potential action in these prices. But risk appetite is really what, in the short to medium term, is going to drive this. And at the moment, there just is no appetite for risk. So I can see this lasting indefinitely until we have resolution in Europe and elsewhere in China. And, are we back on track? And if that happens in the next 3 months, then you're going to see a significant rebound in equities. And if it happens in the next 3 years, it's going to take longer.
Yeah, it's all about Europe, it seems, right now, and all about concerns around slowdown in other parts of the world. But we've seen strong bond inflows into South African assets as well. Interesting, year to date, 54.4 billion rand. That's at the half-year mark, just past the half-year mark. And last year, we only had 41.87 billion rand. So we've already surpassed the entire foreign net inflows into the bond market halfway into the year.
Now, you're right. I mean, we've seen massive inflows into the South African bond market. But it's not a purely South African story. We've seen that inflows across the entire emerging markets. Czech Republic, Poland, Turkey, South Africa were all at multi-year level lows at the long end of our bond curve. And it is that. In the same way that people go for risk assets, they might go just as well for just African assets, and they might invest in South African bond yields. I mean, to give Kubi showed a graph earlier of the various yields in the 10-year points. To give you some numbers, Japan is trading between 0.7 and 0.8% per annum. So it's 0.7% per annum. America is trading at 1.5%, Germany is trading a bit lower than that, and South Africa is trading at 7.2%. Now, over the long term, inflation and currency should adjust to equalize those returns. But over the short term, you're looking at a lot of countries and you're getting either 1% or 7%. Now, it's one of the reasons why you're seeing these massive inflows, because that's the one side. We should also remember that while South Africa has remained as risky as we've been in the past, we've not really gotten more risky, maybe a little bit with some increased budget deficits.
And people also know about us more,
Yes.
for example, being included in the Citi World
Yes.
Government Bond Index. That, of course, raises the profile of South African government bonds.
Yeah, we were included in 0.41 or 0.42% of the index, which sounds small. But if you have trillions of dollars invested in that index, invested according to that index, that's a long and a steady bond inflows that you can count on going forward.
So what is the outlook for South African government bonds?
I mean, let's just quickly just have a look quickly at your screen. Just look at that graph there, the black line, and we showed it to you just now. Just to clarify quickly what you looked at, that is the black line is a South African government bond. That's a 10-year government bond relative to the three big ones we indicated previously, and you could see the yield gap between the two. Guys are buying South African bonds and they're getting themselves a good 8% and 7 to 8% in yields there, relative to globally where they're just getting absolutely nothing. I mean, I'm kind of at a school of thought where I'm thinking, this is beyond logic. People will stop buying bonds when they get a 0% yield. Let me throw a red herring in here. I mean, you guys tell me what you think. At the beginning of the year, proved to me how price inflexible oil could really be. We saw oil, shooting way up, going to $110 and $120. Back now to kind of the $85, $90 kind of level. At some point, when this starts happening again, it could drive inflation. When it drives inflation, this could end the bond party completely.
And food. And I want to bring in the food discussion
Absolutely.
because the United States Department of Agriculture came out with a forecast for crops and saying that production is going to be lower, supply lower. That means food prices up.
And we saw basically a 35% increase in the price of various corn stocks in the US in 3 days. It's one of the interesting things about the irrationality of markets. It's not like in that 3 days people suddenly realize that there's a drought somewhere in America. People have known there's been a drought, but it just kind of, there's been an accumulation, aggregation of evidence and opinion, and then all of a sudden people decide, okay, we're going to have a shortage of food, and food suddenly shoots up by 35%. And where before that we were looking at food disinflation, or food prices going slow and not adding much to our local inflation levels. Going forward, all of a sudden food might be a concern again.
Yeah, and if inflation does start coming up again in South Africa, that will be a concern. That will make investors internationally question the return they'd get in South Africa. Do you think a bubble has formed or is forming in emerging markets generally? Roland?
I think domestically, just to start off with, the inflation risk is high in terms of being the catalyst, as Kirby says, but we have seen inflation actually surprising on the downside. So it's all about growth now, not so much worries about inflation. And if that growth comes through, yes, there'll be a sharp turnaround, but we're not seeing this growth. So within the rest of emerging markets, it's the same concern. It's like until China and Europe stabilize, who are the emerging markets going to sell their goods to? So I think the real issue is growth, not inflation.